So good morning, everybody. How you doing? Welcome to the rest of your day. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade Forex, but also energies, metals, stock indices from around the world, and binary options in which you could scalp, but also hedge your long-term cash positions. Isn't that exciting? So how'd it go yesterday? Pretty straightforward, huh? Yup. Yep. Didn't do much though, did it? So I did put a binary on it because I wanted to avoid the volatility, and then follow-on trades later were fairly easy. And everything went as planned, right? There was a very little chance that they were going to raise, and if they didn't raise, the dollar would weaken. Euro USD would go up, USD went down, and that's exactly what happened. How nice, right? Well, Mindiga says it would have thought it would have been bigger, and that's true, but it just shows you how priced in it was. So one of the things I did on Wednesday is I taught people how to use the Fed funds futures rates, the actual prices in the Fed fund futures market, compare them between the front month and the back month to get the differential, and then use that to develop the probability of a rate hike based on prices. And there was like very little chance that that was going to happen. So you can see there that it was priced in the futures market, so it was probably priced in everywhere and showing off. And we have seen volume decreasing in the commitment of traders report over the last month or so. So make sure you do the watch the Fed funds rate, the futures on the Fed funds rate market, and watch the commitment of traders report, and just kind of see how people are lining themselves up. Make the sense? Yup. So you see this pattern here on the USD yen daily? Yeah, we drew it like a week ago. Maybe here. How are my studies going? Yeah, you know, maybe you've forgotten what it's like to be in university. I certainly have. And so I get the situation where you get a complicated formula on the slides that the professor uses. They give you a complicated formula. And then he hands out lecture notes, and the formula is slightly different. Then he actually does the lecture, and he writes it out slightly different. And then you meet with your fellow for a section a few days later, and he uses a different formula. I'm like, well, how am I supposed to memorize like all these formulas? I don't get it. Like, why don't you just use the same formula? Like, it's so confusing. Okay, like for example, M1 money supply makes sense. You would use the notation M1, but then sometimes there's an M-1, which means something else, and then there's a small M1, which means something else. I'm like, small M1, big M1, M-1. I'm like, can you get more confusing? But anyways, I must be I'm just an old dog. You know what I mean? I'm just an old dog. But nothing like academia to take something simple, like global macroeconomics and finance, and make it complicated. All right, so that's that. What would you like to cover today? Remember, I have a simple goal for doing these sessions with you. I want to contribute 1,000 pips to your trading account. That's it. That's my personal goal. Joseph, I said the Fed would consider hiking in December, but I said that last summer, not the summer we just had, like 13 or 14 months ago. So nothing's changed. And I still wouldn't do it if it were me, but there's a lot of pressure building up. And so I think they're going to do a token rate in December. But even then, I'm not quite ready. But, apparently that's what they're going to do. Trend trading. Oh, very good, Moet. Yeah, we can do that. By the way, where have you been? Have you been away for a while? Oh, well, it's nice to see you again. I hope you're back home. Yeah. Oh, my pleasure. Um, okay, so long-term trading, is everybody good with that? I'll interpret that as a position trade / carry trade. Chris Christie says, December, it's Christmas time. Yeah, well, see, there's no press conference in October. So I don't know, that kind of diminishes a policy change if there's no press conference, right? Like, why change policy and have no real ability to go out and talk about it, right? You know what I mean? So October seems a little less likely. So then it leaves us December, and I guess that means they squeak it in there right before the end of the year. And it should already be priced in anyways. You know what I mean? Like, does a 0.25% hike at funds rate, does that change much? I mean, is it a radical change? Where suddenly you're like, oh, well, we can't go on Christmas holidays this year because we have to change everything at the bank. It's like, all right. So they said this year, the only reason I'm saying December now is they said this year they would do it. So what can I say? Well, okay. So if Janet Yellen calls a press conference in October, she says, well, we don't have a scheduled press conference, but I think after this meeting we should have one. Wink, wink, nudge, nudge. What do you think that means? Green light on the rate hike, right? So whatever. Okay, so if she makes that call, you know what to do. Buy some bucks. Well, Dale, she's not going to say what month. So she's saying, she can, whatever. They can do whatever they want. Okay, so that's that. So a position trade, all right. And the interesting thing is you're probably going to have to wait for a while to get one, but how far is this going to fall is going to be the first one, huh? All right. So for the number one thing that all traders must pay attention to, whether you trade the 1-minute chart or the 1-day chart, is to buy or sell at support and resistance. That will never change. So you must start there. And you can back out and you can measure it various ways. Okay? Right now we're not trending up. We're trending more down. But I would say it's not technically down until we break below this low. So really the way that I'm looking at it is we're range bound. Well, that's important because you want to be in a trade a long time, right? A long-term trade. Do you want to be in a long-term sideways trade or a long-term trending trade? Well, it's actually a trick question if you're a carry trader. The best carry trade is a slight trend. Almost sideways. But you never get knocked out of your trades. And what happens is the market never heats up too much. And some of the reason that you get these pullbacks is anyone that, let's say, longed the position, a big chunk of those traders that did buy the currency pair take profit, and then it floats back down, and then some more buyers come in, they buy it back up, but you never got knocked out, so you're fine. And so it's being traded, but it's not necessarily a one-way street. Maybe there's no bears, but it's not just red hot moving fast and furiously in one direction. Because if you get that, what happens is when there is a pullback, it's a dramatic pullback. And the volatility makes it very tricky to manage risk. And if you're a professional trader, you care most about risk. The reward is not really a function of what you're doing. You can control risk, but you can't control reward. Okay? So really, ideally, slight sideways, slightly up would be perfect for carry trades. Contrast that with any just sort of position trade. If you're in it just purely for the pips, hey, fast and furious is good as long as you get out. And you'll likely get out at the next giant support or resistance. Or trade the price action. So what's the most important part of a bullish price action? Absolutely, J.G. Wentworth. Higher high, higher low. So the way that you're going to make your millions and billions is this. That's it. You don't need oscillators. You can get rid of your MACD if you want. You can get rid of your Stokes if you want. If I had to keep one, I'd keep the Stokes in a price action market. Right, Marina? So, up, down, down, up, down, down, up, down, down. And, Chris smiles there. He says, it's just that easy. You know what? Honestly, it is. And if that ain't working, it's because either the market is not trending, it's not trending up, or you're just screwing it up, right? I mean, obviously, buying this dip is not going to work if the market's moving sideways. Buying this dip is not going to work if the market's falling. Okay, so a long-term trade the other way would look like this, and you're selling the rallies. Well, Wyatt, this is a long-term trade, right? So am I looking at the 15-minute chart? Maybe just when I pull the trigger, but as far as the pattern's concerned, no. So there is no higher time frame. Right? Well, no, I know. I'm just saying you want to start high and then drill down to enter your trades. But look at the trade I'm in now. Well, it's not on this platform, obviously. But anyways, look at the trade here. It's a long-term trend. Okay? What was the trade? sold it off of old support, should go down. And now it's just hold. Now, isn't it nice that the fundamentals are also going in that direction? Yeah. So I have two choices here. Take profit at the bottom or let it fall further. I'll show you here. 50%, I'm going to play it like it's a 618 just to be conservative. A 618 predicts a 1382. So the aggressive target here is a $1.14. 114. And that would be an example of a longer-term trend, right? Or a longer-term trade. That's going to be a while, isn't it? But the pattern is pretty simple, right? Double top. By the way, I set you guys up with this trade a week, maybe even 2 weeks ago. Double top, lower low, lower high, into the roll reversal. What's the key word? Hammock. All right. I mean, come on. Boring, right? Just, yeah. I mean, what else would you do? So there's two targets now, here and here. Okay. So as long as it's heading down, it'll be fine. Okay. But we're in this situation where, mousy mouse, where's my mouse? There it is. Okay, do double tops exist in uptrends? Okay. Does a lower low exist in an uptrend? There's no lower low in an uptrend. Never. So if I'm a bull, I just now wait. Okay? That's all. But if somewhere along the line it decides to make a higher high, well then, maybe then it's reversing. But I don't bet that it will reverse. I hate betting on reversing. My favorite way to trade a reversal is not to bet. So I don't often sell tops or buy bottoms, or even sell double tops and buy double bottoms. Because it's still a bet, isn't it? Bet you anything is going to fall off this double top, eh? So my favorite trade is sell after the double top, lower low, because that's called a change in trend. Well, Mohit says it pays to look for pairs that are trending rather. Well, yeah, that's true if you're looking for a trend trade. Okay. So anyways, identifying the market conditions are important, guys. Now, if there's an uptrend, do we have any resistance? That's right. Only support unless price indicates that everything is slowing down. So, for example, what if the next high is only this high? And then starts to come down. Is that extremely bullish or just modest? Extreme or modest? Yeah. So shouldn't you change your expectations? Okay. And on a retracement, what's the maximum you feel comfortable buying retracements? Let me say it the other way around. Do you feel comfortable buying a 50% retracement? Do you feel comfortable buying a 618 retracement? Do you feel comfortable buying a 786 retracement? Yeah, maybe. Yeah, it depends. But then it looks like this, doesn't it? There's your 786. It changes things a little bit, doesn't it? But an amateur won't change. They just don't look at it. They just don't look at it. They just, I don't know. Okay, so it does matter. The market is likely consolidating. And eventually you get something like this. Okay? Are there as many bulls in this market as there was before? Could the bears possibly jump in and hunt some stops? Okay, so the next wave would look like this. Okay, is that an uptrend? WWWD. What would Wayne do? What's my next move, bro? No, it's already reversed. We've already had the reversal. That's a triple top. Some people would also call that a head and shoulders. No, I don't have a Mercedes, Jody. I sold it and bought a golf cart. All right, I would look to sell that. Yeah, the AMG was just too pretentious. Yeah, you know what? I actually spent more than $1 per mile in maintenance. Isn't that amazing? All right, there we go. Yeah, I owned the car for, I don't know, what, 5 or 6 years, and I put something like 20,000 or 13,000 miles or something. Yeah, I was in a Tesla just last week or the week before, and they're nice. I mean, they're all right. There's lots of things I like about Tesla for sure. In particular, the design. Just by design, it's a better car by far. But okay, so anyways, guys, this is how I trade, and that's how you recognize a reversal. Okay? What I call an old man easing into a hot bath. You can see the velocity is slowing down, right? we have sort of a steep angle, right? And then a flattening angle. All right, and then what? A reversal. Okay, and the next trade after that, just to make sure you're following the price action idea, I'm going to sell that rally. Okay? Capiche? Now, I'll do that 15-minute chart, hourly chart, 4-hour chart, daily chart. It's all good. Okay. So anyways, you get yourself into a long-term trade by just looking at the market, asking yourself, is it trending? Is it sideways? And it's actually, to me, sideways here. And I believe it will go up. But what if the Fed doesn't raise interest rates till December? Well, I've already made a prediction that Japan, the Bank of Japan, will announce additional stimulus or expansionary policy of some sort, like maybe an increase in quantitative easing, at their meeting at the end of October. Okay? That's a long ways away, guys. So by the 18th of September to the, the 28th of October, what is that? Let's say 40 days. What will the 40 daily candles look like on this chart, guys? Is it possible over the next 40 days that we can get to the support level at 116? How would you say it in percentage-wise? And I mean, not that it is going to do it, but that it could do it. What percentage? Is it maybe only 50% it could make it there if it was going there, or is it like 100? I think it totally could. I think if it wants to go there, we could easily do it. Again, not that it's going to do it, but if it wanted to, it definitely could without a problem. Okay? I mean, we got the price action. We got the fundamentals. Look, why would you buy dollar if the Fed's not going to raise interest rates for like another 100 days? You following the train of thought there? Well, Pan, you're never going to get the same across, 8 different assets. The only thing the same amongst yen pairs is the valuation of the yen. But why would the pound be the same as the dollar and the same as the euro and the same as the Canadian dollar, the same as the Aussie dollar? Right? I mean, just there's no same. It's all relative. That's what we do. So in that case, what you would do is a relative strength exercise. Okay. So anyways, guys, I think over the next 40 days, we could do it. I mean, look at this. The last time we were there, we bounced up 1, 2, 3, 4. In 5 days, we rallied up to our most recent higher high, right? So look, over the course of 40 days, I think we could go to the 113. Not that we're going to, but I think we could. And what if the Bank of Japan doesn't add additional quantitative easing? What's the likelihood over the next 100 days that the USD yen could go down to 112 or 113 if it wanted to? Again, not because I'm saying it will, but I'm just like, if you add more time and less change in variables, there's a lot of people that long this with two basic assumptions. The dollar would increase in value and the yen would decrease in value. Well, they could be wrong. Parity? What are you talking about, parity? What am I missing, dude? Parity. All right. Well, okay, let's talk about that. I don't want to get too distracted because we do have a topic here, how to trade long term. But if USD yen goes down, why would Euro USD go down? That doesn't make any sense either. Well, Mylan, everyone was screaming Euro going to parity, and at that time I thought it was funny. Anyways, and I said, well, why? What's the big deal with parity? Why not 80? But where were they wrong? They were wrong that the Fed was going to raise interest rates. They were just wrong. I mean, and it was laughable. You guys remember in February where there was like a 100% chance the Fed was going to raise interest rates? And I couldn't stop laughing at the absurdity of it. Like, it was so dumb that I couldn't believe that people were even talking about it. Like, what a dumb thing. Like, whoever's in charge of all these billions and trillions of dollars, they're dumb. It's amazing, like, to even have the conversation raising interest rates back in February. Just like ridiculous, just absurd. So, anyways, if, or let's say when, the Fed is on a sustained rate or a sustained policy or a trend in policy of raising interest rates, the Euro USD will go to parity. And then even below. Look, I've actually bought the euro at like 83. I remember the day when it went above parity, and I'm like, wow, the euro's worth more than the dollar. Wow. I remember that day. Who cares about parity? So anyways, so yada, yada, yada. They got that wrong, just like a lot of people got a lot of these dollar pairs wrong. The idea is right, but apparently they know nothing of macroeconomics and central banking policy. Okay, so whatever. But it will happen, meaning the Fed will raise interest rates. The ECB will do quantitative easing until well into 2017. And when these things come together, I'll be short Euro USD. It's not a problem. It's just a timing issue. But I wouldn't go out and spend the money yet. You know what I mean? You still got to earn it. Parity is another psych level. Yeah, but I'm not easily psyched. All right, so anyways, how do you get the trend going? Well, there's a couple of other things going on here besides price action. What do the moving averages tell you? What do you see here on this daily chart? Am I aggressive or am I conservative? I'm aggressive. Hey, moderator, if you're around, do you have the link to the 2-hour video? People need to know this. So if you happen to be listening and have the link available, that'd be great. Yeah, boy, there's these huge gaps, guys. You have some huge gaps in your trading. Holy smokes. Well, I guess it's why I'm here, right? I'm here and I want you to succeed. I hope you understand that and believe it. So we need to dive into this. The 2155 here, I use them together, and they represent the market. Now, when you meet with your buddies this evening, they might come up to you and say, hey man, so how's the market going? How do you answer that? Do you say, well, you know, at 8:30 in the morning, I took a 5A cross on the 15-minute chart, and then it went up, and then it rolled over, and then I got the 5-minute scalp on the downside, but then it bounced off of support, and then so I waited for the double bottom and got the higher high, so I fibbed that sucker, and then and they're like, dude, whoa, 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 whoa. I was just being polite because I actually don't care about what you're doing, but what's going on in the market? Are they going up or are they going down? Right? Isn't that the basics? What did the markets do today? Were they up? No, they were down. Okay, that's all. So I need a measurement of two things: the direction of the market and the speed of which the market is going in that direction. Do you believe those two things are relevant? Right? Am I a bull or a bear? That's direction. Am I aggressive or conservative? Genius, genius, genius. Starts to make sense all of a sudden, right? Because I need to adapt my expectations of the market to actual market conditions, because I know I care about the market, and I also know the market doesn't give a damn about me. So I better pay attention. Okay? So, if the market is moving quickly, should I be aggressive or conservative in my trading expectations? If the market is moving slowly, should I be aggressive or conservative in my expectations? Thank you. Now we're getting there. Muy bien. So, to do this, I use a combination of two moving averages. I use a 21 EMA in orange and a 55 EMA in blue. Notice the Fibonacci ratio relationship between the two. Okay? If the 21 is above the 50, or sorry, if the 21 is below the 55, am I a bull? Am I buying? Hey, let me buy that. Mm-hmm. No, I'm a bear. So isn't that a helpful thing to have right off the bat to know whether you're a buyer or a seller in the market? See? This is why we work together. I hope even just subtle things like this have a massive impact on your trading. Okay, now there are times when, let's say, price is well overextended, and you may end up buying because, you look, the 2155 was up here, but price was down there. But that's pretty rare, far in between, right? Generally, if the market's bearish, you're a seller. Okay? No, the 13 EMA sucks, Mark. Just terrible. No, I'm joking. No, I'm joking. I don't care what the moving averages are. So to measure price, just use a combination of two short-term moving averages. And then to measure the market, use two medium-term moving averages. You like three, so what you're doing, okay, what you're doing is you're combining a couple of things together. And I think over time, you should adjust that. I mean, let me finish my conversation. You'll see what the last 12 years have done for me. And I'll tell you exactly why I use these moving averages. So like three, I know what you're doing, and it would probably work most of the time. But then sometimes it's just going to do stuff you don't get. And you're going to like, man, what's it doing? I don't get that. And I think I can explain why, if you don't mind. Would that be okay? Yeah. First of all, you have to give me $1,000. We'll talk about that later. You send me $1,000, I'll tell you. I'll fix your little problem with the EMAs. All right. No, I'll do it for free because I'm awesome. Awesome. All right. 21's below the 55. I'm bearish and I'm aggressive, and there's nothing in this world that can stop me from selling. Okay? Okay? Nothing in this world is going to stop me. I'm going to sell, and there is no support in the marketplace. Do you understand that, guys? Because price is below the 21. Where's my mousy mouse? Come on, mousy. Because price is below the 21 and I perceive the 21 in control, I'm a bear, I'm short, I'm selling. There's no way in the world I'm going to buy. And in fact, there is no support. This thing is going to fall forever until it reverses. Right? Until it reverses. But there's nothing on this chart because, you know, when you watch an amateur trader trade, they're like, oh, well, but what if this what if this holds and then what if it reverses and I could go long but it might go short and I just don't know what to do and I'm all over the place and right? And they just freak out. I look at this and like this is going down in a blaze of glory. That's it. I'm done. I know exactly what it's going to do. This thing's going to fall like a ton of bricks until it reverses. But see, I'm not going to deviate until the market has deviated. Again, a small sort of change in attitude, but do you think it has a powerful effect on your trading? When you trade with certainty and with absolute total clarity? It's very important stuff, right? Because I'm not double guessing myself. And of course, am I buying it? Can you imagine? I can't buy it. It's bearish. Okay? So the 21 is below the 55 and it's bearish. Well, what if today we somehow close higher and price goes through the 21 on Monday and we find ourselves at the close of Monday near the 55 EMA? Is that an important change? That we revert back to the mean, the 55 mean. Am I bullish if we break above the 21? No. Has the market changed? Yes, the market has changed. The market has slowed down. If it was aggressively bearish or if it still is aggressively bearish as it once was, it would make a lower low. It wouldn't be up here. Does that look aggressively bearish to you? Do you see that and go, oh my gosh, I can't wait to sell that. That's like free money. Whoa, what? That's danger zone. Right into the danger zone. Right? That's, wow. That's scary. So I'm going to have to change my expectations. And that is an important thing, to change your expectations. And what I end up being is I'm still a bear, but I don't think we're going to make a lower low. I think we're going to bottom out. And so suddenly I see the market like this now. Okay? And I changed my strategy. Boop. And I'll probably start range trading it. Now I bring in my oscillators and so on and so forth. Okay? And I adjust my expectations accordingly. Which means now I will take profit on the bottom. But in current market conditions, I don't want to get rid of that one. Hang on. Under current market conditions, I'm a bear, I'm aggressive. Am I going to take profit down here at 119.00? Am I going to take profit? Hell no! Because my expectations are different. Now, is it important to you as a trader to know when to hold them and know when to fold them? Yes. Well, that's my trick. So for Marky Lou, he uses 3 moving averages. And I think I know why. So I use the 2155 to represent the market. Let me go in a little closer. Do you see that there's a red and a black moving average? Yeah. That's the 5 and the 8. That represents price action. Price now. So what I do here is I differentiate market forces with price action. So the 2155 is just one indicator. I don't see 2 moving averages. There's only one to me. It's just one indicator. Market's bearish and aggressive. Done. I don't see anything else. Then I say to myself, what's price doing? And why is that important? Well, when your buddy asks you at the end of the day, hey, what's going on in the market? You say, well, right? Well, the USD yen's down. Okay. The USD yen is bearish. Okay. Does that look bearish to you? What? So price can go up and the market can go down at the same time? Whoa. That can complicate things a bit, right? Say, what? Wow. So, you know, little Wayne McDonell, when he was only 3, learning how to trade Forex, I said to myself, I need my bubba, my blankie. No, I said, hey, if market can go down and price can go up at the same time, I wonder what would happen if I only sold when price was starting to go down too, in the same direction that the market wants to go. I wonder if I'll do better trading in the direction of the market. So I'm going to need a tool for that, because I got the whole market thing going on. So how am I going to measure price? Shorter term moving averages. That's why I don't use 1 for price. Just like the 2155, I look at crossovers and angle and separation. Okay? Is there a different indicator that you could possibly use that looks at crossovers and angle and separation? Let me get a MACD. Whoa, what? MACD is a moving average. All right, so the 2155, they're moving averages, right? No, not stochastics. Let me finish, okay? The 2155, they're moving averages. So the MA in MACD, MA is moving average. Convergence means 2 moving averages are moving closer together. Divergence means 2 moving averages are moving away from each other. What? That's what a MACD does. It looks, oh snap. It looks at the 2 moving averages and then will tell you, are they moving closer together or farther apart? Okay? Is the 21 above the 55 or below the 55? I don't know. There's 106 people in the room. I think I'll wait for at least 30 answers. Oh, this is a good webinar, but I don't want to have to type too. All right. Okay, look at. Yeah, on this time frame, but that's all we're looking at. So that means the MACD must be above the water line. The water line is the 0 line here. Okay? So right here, the 21 crossed above the 55. You ready? Hang on, I got to match it this way. Okay, ready? Oh! 21 crossed above the 55. Hoo-ha! Okay. So what is the MACD saying now that it's going up and up and up and up and up? All this means, guys, is the 21 is diverging away from the 55. So now that you know how the moving average or the moving average convergence divergence indicator works, you can change your MACD to represent any 2 moving averages that you want over whatever time period you want. Because I was using the 2155 to represent the market, I adjust my MACD to be 21.55.8. And now you know exactly what I'm doing. I'm measuring the 21 and 55 EMAs over the period, over the last 8 candles, essentially, right? Over a period of 8. Genius, genius, genius. Now you actually know how a MACD works. Well, this is important to a trend, guys. Okay, by the way, oscillator, the stochastics, doesn't do anything like that. Completely different math. Okay? We'll cover that some other time. But I think if you're trading the market, it's helpful to know what MACD is doing. Okay? And why I separate these things is important too. Now, using the 5/8, I'm using price action. Price action, not market. I'm already a bear. You see? So I wonder if I'm at resistance and I'm a bear and I'm aggressive, could I possibly short when the 5 EMA drops below the 8 moving average? Wouldn't that indicate that price is now falling in a falling market? Oh, snap. Now you've figured out what I was doing 10 years ago. I decided to measure 2 things: the market and price, and trade when they were congruent. Genius, genius, genius. Okay, this is going to be important for a trend. If you're counter trend trading, is your trade going to last a long time or a short amount of time? Right. Short. And so the question is, Wayne, how do I get into a long-term trend or a long-term trade? Well, one thing that would be helpful is to trade in the direction of the market. And in particular, when the market is moving in that direction very quickly, so you get in a trade and you let the winner run. Okay? The reason I use 2 moving averages, though, on price is I need the crossover. That's why I was saying Mark with 3. I think he's doing it right. Generally, there's a more aggressive zone and a little more conservative zone, but he's blending price into the market, and it doesn't give you a trigger where you could use the 5/8 cross as the trigger and say, okay, there we are at resistance, but that's where I sold. Okay? And also, the 5/8 cross can take you out for profit. So this thing could come down. Let's say it does hit support and bounce up and gives you a 5/8 cross up. You can just take your profit down here on the 5/8 cross up. So it's helpful to get into trades and out, but it's not helpful because it's a crossover. I mean, it is, but that's not it. It's helpful, Mark, because I'm differentiating price from market. You're combining price and market, and it'll work most of the time, but you're missing some subtle clues when the market starts to change. And you'll be in probably one too many trades in a trend. And even though it's showing you signs of reversing, you'll probably, let's say, buy it one more time or sell it one more time and lose on that one. And so I bet you a lot of the time it's working just fine, and some of the time it just kind of fails you a little bit. So I would consider adding another moving average, and then again, more importantly, not just the moving average, but that you're looking at the market and you're looking at price as two separate entities, and that's probably the thing that you're missing, because you'll see when price is too far from the market that it's going to snap back like a. In my book, I talk about it being like a rubber band. Let's say you put moderate tension on a rubber band. You stretch it out, you let it go. You stretch it out, you let it go. You stretch it out, you let it go. Works fine, right? Not a problem. And that's what you're generally doing most of the time in your trading using those three moving averages. But what if you stretch and stretch and stretch that rubber band? Well, it doesn't have to snap, but just imagine you got it at near full tension. Is it difficult to get it stretched out to a little bit more to absolute maximum tension? I mean, the difference between 99 and 100, right? That's exponential. Right? That's how it works. Like physics tells you that the faster you get to the speed of light, the exponentially more difficult it is to get to the speed of light. And then when you let go of the rubber band, what does it do? It goes right back to its average tension. It reverts to the mean. And that's what happened in a situation like this. Look, price was up here. Well, no, the market was up here, and price was way down here. It's just too far, too fast. Very unusual and unnatural. Okay? Yeah, you're always measuring these things on time frames, guys. But let me ask you something. If the market is down on the day but up on the hour, on the long run, which one's going to win? And we're talking about a long-term trend, right? So are they congruent? No. What are we talking about? Long-term trends by trading with congruency. Congruency of market forces and price action. But the next thing is called fractal geometry, where you're using congruency on time frames. So you might as well wait till your hourly chart turns bearish too. Like the 2155 cross, or even just a 5-8 cross at resistance, and you're just going to front run the inevitable. But it would be, you're more likely to win if the daily says down and the hourly says down. And that's the next step. Okay. So now you're bearish, you're in your trade, you're aggressive because the 21's in control, there's no support, this is going to fall forever. How do you manage your stop? By the way, Canadian CPI, 0.0. Congratulations, Canada. 0.0. Good show. Yeah, let's use parabolic stop and reverse. Insert. Indicators. Trend. Volatility-based stop loss placement and adjustment indicator. Well, this one's tricky because it still thinks you're bull. Well, that's not helpful. PSAR thinks you're bullish. Whoops. So I was going to suggest that, but no, that ain't going to work. Well, if you're in it long term, what I would do is I'd jam my stop and just let it run. And if it if it hits support and 5-8 crosses up, you can take profit if you want, but you're being a scaredy pants. Would you like to hedge this? Because you don't want to get out. Well, actually, let's reverse this whole thing. I wouldn't mind getting out of this trade eventually. I would rather be long. But I'll hedge it the same way, whether I'm long or short. If I'm long and the trend is up, I just simply want to be in the trade forever. Because if I'm long on a carry trade like even an Aussie yen is going to pay me 2% yield. Right? That's not bad, is it? Well, if you're leveraged if you're leveraged 100 to 1, you're going to earn a 200% return on investment. Just on interest. Are you okay with that? See, that works because you take $1,000 roughly, depending on what the required margin is, and you buy Aussie yen, and let's say that gets you one standard lot. It wouldn't be that far off, let's say. All right, but let's go with the logic here. You take $1,000 out of your trading account. So let's say you have $10,000 in your trading account. You take $1,000, use it as margin to buy $100,000 of Australian yen leveraged against the Australian dollar versus the Japanese yen. Okay? So now you own $100,000 of Aussie dollar. You've ponied up 1,000, but you're trading 100,000, and you're earning 2% interest on the $100,000. So at the end of 1 year, having earned 2% of 100,000, how much have you earned in dollars? What's 2% of 100,000? 2,000. Well, how much did you invest in your real money? What do you think? Is that a pretty good return? I know we're all different. Is your bank paying you anywhere close to 200%? Is your bank paying you anywhere close to 100%? Is your bank paying you anywhere close to 50%? Is your bank paying you anywhere close to 25% or 10% or 5% or I mean, it's absurd, right? So you never want to get out. So like, would you be okay if you were in that trade for exactly 1 year and 365 days later you get knocked out at break even? And you didn't even earn a pip. You're like, oh, well, at least I walked away, right? Imagine that, guys. Your $1,000 is now $3,000, and you didn't earn a pip. So anyways, you want to be in the trade for as long as possible. There's other scenario like, what if you really want to buy the USD yen soon because you believe it's going to go up? This is bearish. Would you agree that this price action, high, low, lower high, lower low, lower high, you'd have to be pretty aggressive to buy this, wouldn't you agree? Is that right, Rick? Lori only trades Aussie yen? That's it? That's interesting. Seems like you could be a little broader than that. Okay. So here's how you get into this trade aggressively. I'm going to hedge it either way. So there's two assumptions as I wrap up here. One, we're going to try to buy the the USD yen here because we believe fundamentally it's going to go up. But we understand that the market is technically bearish. So how do you get into an aggressive trade and reduce your risk is one assumption. The second assumption is, what if the market is bullish and it's a yen pair and it's a carry trade and you want to get into the trade and you want to move your stop to break even, but you don't want to suffer pullback, so you're going to hedge. But you're not going to hedge with cash because A, you face volatility, B, you have unlimited downside risk, and C, you have to pay interest. But you're in the damn trade, pardon my French, to collect the interest. So why would you hedge cash with cash? It's not like you're fighting forest fires with fire. That makes sense. Hedging cash with cash, you're just confused. This is why professionals decades ago created derivatives, for crying out loud. So let's use a derivative. I'm not going to be able to today. Looks like they're upgrading the server. Oh! Either that or I'm having browser problems. Could be both. So anyways, you would hedge with a derivative. So in this case, if I wanted to buy the USD yen at 119-ish, wherever we are now, right? But I understand it's terribly aggressive. Okay, I buy it. What do I do to hedge if I was using a binary option? What would I do? I would use an option to make money in a falling market. Okay? So that if price falls, I'll make money. And since I longed it aggressively, I'm losing money on the long, but I'm making money on the short. So I'm offsetting my risk. Okay? Let's say my stop on the long is just below here. So I'm like, as long as it doesn't make a lower low, I'm fine. So I'm making money down, losing money on the up, and they're sort of offsetting each other. Okay? And it kind of keeps me in the market. But I don't face volatility on the option because this thing could go up and up and up, and I'd be right. I'd say, I told you it was going to go up. That's why I bought the cash position. It's going up. I have unlimited upside. I'm getting paid interest rates that are positive for me. I'm in the trade I want to be in. Well, what about my option? There's a predefined loss. I can only lose so much. I can't lose more. I can't lose less, but I can't lose more. The option, which is like an insurance policy, will simply expire worthless. And I just bought some insurance on my long-term long, even though the market was short-term short. And I got myself into a trade aggressively because I want to buy this as low as possible, but realized I was being aggressive, so reduced the risk by shorting the market with a derivative that had very little sort of reduction in my alpha on the upside. Okay? And I would do the exact same thing if the market was still long in a bullish trending market. But we know there's times when the yens dip, don't they? Very often 300, 400, 500 pip dips before they rally back up again. If I wanted to be in a situation where I never, ever, 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 ever get out of the trade, well, you can leave your stop at break even, collect the interest every single day, collect the good pips on the way up, but when you hit obvious support or when price is obviously extended very, very high and obviously wants to come back down for a day or a week, you can use a binary option to make money on that short-term short, knowing that you're not facing any volatility risk, which is another way of saying there's no risk management risk. How often have you been in a good trade, but your stop was too close and you got knocked out and lost money despite the trade being good? How many people have done that? The market's going up, the price is going up, you bought, but you still lost money somehow. Yeah, like an unbelievable risk, isn't it? I mean, a real serious risk. Okay? A binary option doesn't have that because you could be down 500 pips and you're not going to lose any extra money. It'll be the same as being down 50 pips. It doesn't matter. All that risk management is built in. There is no stop loss. You don't need one. Again, because a 50 pip loss is going to be worth the same as a 500 pip loss, which is the same as a 5,000 pip loss. It doesn't matter. Your option would just simply expire worthless. And you simply bought an insurance policy to protect a trade you plan on being in for weeks, months, and maybe even years. And that's how or why derivatives were developed in the first place. So anyways, guys, I apologize. I went 3 minutes over my session. But thank you for a really good topic on how to make a longer-term trade. Thank you to FX Street for hosting us again. I've been working with FX Street for over 10 years, and they're good people. I thank you for your loyalty. I provide coaching every single day for clients of tradersway.com every Monday through Thursday. And, of course, every Friday here I'm at FX Street, either for these strategy sessions or the first Friday of every month for Trade Non-Farm Payrolls Live. I want you to succeed, and I hope you make an extra 1,000 pips because you hung out with me for a while. And I hope when that does happen, because of your hard work and tenacity, that you're willing to share that success with the world. Tell them Wayne sent you. So peace on earth. May the pips be with you. May your profits be above average. And swing on by tradersway.com. We'll take care of you. You hear?